here. What are the hottest growth stocks you can think of? I can give you a few. How about this? MongoDB. All my friends in Silicon Valley, I think they own MongoDB. Take a look. 78 times 4 PE. Not a bad entry here, by the way, but what's your upside? This high valuation acts like a corrosive force on the stock. Because when people make a decision, institutions, they look at that price, they look at the value. And if you're not investing in what institutions will invest in, you're going to have limited upside because there's no big buyer to sponsor that stock going forward. You could buy a quantum computing stock. That's going to be a 2 to 4 week idea because you're going to be there with the herd. When the herd leaves, there's no institution to carry it, right? Take a look at Workday. These are world-class businesses, by the way. They're phenomenal. I've owned these businesses in the past. In 23, we owned these businesses. They were a lot cheaper then. So, you're below February prices. And meanwhile, QQQ is at all-time highs. It's a hot business. It's an expensive business, right? And these are more expensive than most of these Mag 7 names. Why would you want to own these? Meanwhile, you've got this Argentinian bank that's up 200%, okay? Or like I mentioned, Jackson is up like 100%, Innova's up 70%. So why wouldn't you own some of those other ideas? So this is Jackson, yeah, year to date 75% 1 year. It's an interesting idea, right? Here's another one, a different category altogether, Abercrombie and Fitch. NF, I was actually at the Paramus Mall yesterday. I was meeting a buddy of mine. We get together every 6 months for lunch and dinner, and we talk markets and ideas. He was a Columbia Business School guy and grew up in the Warren Buffett School of Thought and Thinking. And although he also owns digital assets and he has interesting portfolios. So, but the mall was totally packed. I had to drive around for 20 minutes to get parking. Before you could even get parking, you were in the lanes to access the parking. I'd never seen that before, although I don't really go to the malls that often, but it was packed. They had double the valets just to help with parking. And I did poke around the mall here and there. It was retail spending will be very strong. The consumer is strong. Okay. That's an N equals 1 anecdote. We look at Visa spend. The consumer is strong. I generally don't like retailers, by the way. I generally don't like these kinds of businesses because it's hard to find compounders, right? A compounder is a business that can reinvest in itself, take the free cash flow, open up a new location or branch or store, and then generate similar sales as their prior stores and keep doing that again and again. And they compound and they grow earnings. And so we had a big trend of these quality compounders in retail in the 80s and 90s, like Sears, the Macy's, and the department stores, and Amazon showed up. But restaurants, you've seen that quality compounder trend with businesses like Cava, which are pulling back now after hitting like 300 times forward earnings. But this one, I think, is mispriced. ANF is 13.6 forward PE, and the earnings growth is significant. So that combination together, I find interesting, coupled with the fact that they are investing in growth. They are opening up new locations and they're doing international growth. So they're expected to grow revenue 15% next year. That trails off. We'll see. The analysts could be wrong in this assumption of the revenues trailing off, by the way. And then the EPS growth gap, 71%, 60%. So if this multiple holds, if that trailing PE holds at 15 times and they grow earnings, let's say it's 50%, then one of two things happens. Either the price of the stock goes up 50%, or if the multiple doesn't hold, then this multiple compresses to 7 times earnings. So I like that. Now what's happening with Abercrombie is that they had a strong run in the recent years. You can see that. And this is like this went from $30 to $100. It was like a 4 times return in the 23 era. So it's been consolidating since then. Okay. You can see the chart now. I lit it up on my screen. It had a monster 2023. They got a lot of hype, a lot of excitement. It was overbought. It's pulled back here, and now it's just consolidating. And this is called a volatility compression pattern. So it's churning out weaker hands, and stronger hands are slowly getting in. So it might keep doing this for a few more months, by the way. But the way these things work is I've got to make my stock picks for the next year today, and I can't do it 2 months from now. So I have to share that now. But yeah, I think this is a good one. I think to other themes. Banco Macro. This is an Argentinian bank. It's got a 4P of 9.3 as well. So it's cheaper than the American banks, but let me tell you more about this business. I learned about this one, by the way, going through Druckenmiller's 13Fs. He had 2 Argentinian banks. We own them both. So when we looked at the 13Fs, we went through these names and a couple dozen of those names. And we thought, what the hell are these businesses? Remember when Druckenmiller first got involved with Argentina, he just bought the index. right? After Milley and his regulatory reform stepped in, he just bought the index. So he refined his expression. He got smarter. He said, I want to bet on the banks, which makes sense because banks are how you bet on GDP growth and improving economic outcomes. And they're great businesses. They're classic compounders. So we looked at this and we said, yeah, this makes a lot of sense also. So this business has strong metrics. Here's some of the statistics. Their loan book is growing 25 to 30%, which is growing pretty quick. You don't always want to see fast loan growth at a bank, but they have a leadership position there. They've increased their provision for loan losses too, which is good. So you pair that with the loan growth and it starts to look more sustainable there. So I think that's a thematic bet. I think you can own other Argentinian banks as well. Now, this name has done 30% in 1 year to date, 247%. The last 3 months, 44%. And the last 1 month, 23%. Okay. That's a value stock. Okay. So here's another one. The old Flextronics. This is a data center adjacent play. It's an interesting idea too. We own Celestica, by the way, which is a similar idea to this. That's already run up. It's agonizing whether to put that on the list here or not. And I think Celestica will continue to run up. But this is still early on its trend development. Okay, so Flex, they provide manufacturing solutions to a variety of different companies, flexible supply and manufacturing system comprising communications, enterprise, and cloud, which includes data, edge, and communication infrastructure. It's a mouthful. Let's take a look at what the AI has to say about Flextronics. So all these data centers getting built is a driver demand for this kind of business. Right. So they have done a strategic pivot, as I say, towards high margin segments like automotive and cloud. And they have significant share buybacks. My friend, buybacks, 10% in buybacks off a decent PE that's well below the S&P 500. Are some of the highlights from the earnings transcript. We believe power and compute-based revenue will account for 40% of total revenue for Flex by fiscal year 20. They've done some M&A recently. They acquired a company that provides some data center cooling technology as well. So it's an interesting idea. Totally in the dumps. This is called First Solar. So First Solar was a hot idea a few years ago. Had a fall from grace. They are a leading solar technology company. They provide photovoltaic energy solutions. Their customers include data centers like Google. So Google has a mandate to be energy independent from the grid by 2030. And they're going to get there come hell or high water. That's going to include nuclear, hopefully, but nuclear will take too much time. So solars are going to be a key part of that. They need solar to power these data centers and to meet their mandates. That's one driver. The other driver is China has a competitive advantage over the United States in solar. There's no doubt about it. They can produce solar far more cheaply than the US can. But Trump has tariffs on China. So that gives First Solar an edge. The risk for First Solar is that Trump or the Republican Party dials back the Inflation Reduction Act and the tax credits for investing in solar. That's the risk. That's why this has sold off in the last several months since July. You could see, by the way, the market was pricing a Trump win, right? If candidate Harris had won or was going to win, this would have been going up because the IRA Act would be intact. But I think that bad news is priced in here. I think that bad news is priced in. And it's unlikely that we'll see those credits go away. And if they do, I'm getting a 9.7 times forward PE, right? There's some policy risk around this. I think I'm paid enough to own that risk. I don't mind owning that risk. And what else? So this is an interesting idea. If you can study the policy and see where the tea leaves are blowing, you might do very well with it. It's a high ROE business. It is a compounder. They have a dominant market position. I like those qualities about the business. Non-consensus free cash flow and buybacks. Who's talking about Innova? No one's talking about Innova, right? It's got a 4 PE of 9.5. When we bought it, it was around 7 times. This company makes high interest rate loans for people that are underserved by the banks. They primarily in the US, but they also have some international footprint. They acquired On Deck and they're headquartered in Chicago. I think with Trump in office, you're going to have less regulation of high interest rate loan issuers. There could be some risk there, right? In September, Trump said that he'd want to cap credit card interest rates at 10%. Now, this is not a credit card issuer. It's an installment loan provider. I don't think Trump would do that. It's unusual for a Republican Party to even go in that direction. And he hasn't brought it up since then. That's the risk around an idea like this. I think the consumer is strong It's another reason why I like this idea. You got buybacks 11% too. There's your free cash flow divided by market cap 53%. So I look at that and I say, okay, my base rate return next year is at least 11%. That's better than the S&P average annual return in terms of real terms, right? And in fact, this company over the last 1 year has done 78%, 77% year to date, and the last 3 months, 21%, right? But I think my downside is going to be less limited. Category of other related themes is good too, like Synchrony Financial, I think is a really novel idea as well. These guys do the retail private label credit cards. If you go to Macy's, that Macy's card is powered by Synchrony. It's actually, again, it's a bet on the consumer. I think Innova has an edge on Synchrony, but the whole theme I like is the main point there. So Allstate, they provide property and casualty insurance, right? Homeowners insurance, auto insurance. We like insurance businesses, right? It's a classic compounder business. They've got significant earnings growth as well. You can see that based on the difference between the forward P and the trailing PE, and their price to free cash flow 6.3 times. It's not bad. They don't have buybacks, but it's a stable, large business, stable brand. If you take a look at the trailing valuation versus history, you can see it's cheaper than it's been in looking across 20 years or so. And the states are letting the insurance companies increase prices, pass them on to consumers. So insurance is a category where there are many great ideas, by the way. I just happened to pick this one. Progressive is an interesting idea. Progressive is more expensive, but they're growing more quickly. That's not a bad idea too. So we own multiple insurance companies because I can't say for sure which ones are growing faster than the other. So I want to pick what I think are the best 3 or 4, let them run, and then I can cut my losers, and I should do okay. It goes back to the idea we talked about earlier, normally. So our pick in healthcare, first off, there are a lot of great businesses in healthcare, a lot of quality businesses in healthcare. In my personal portfolio, I own all the names I'm going to share with you today, but we also own other names too. But it's a top 10 list, so what are you going to do? I think Merck is very good. Merck is a leading pharmaceutical company, been around for decades. The valuation is very attractive. It's sold off on all sorts of news, somewhere related to the healthcare industry. What will RFK Jr. do with the Department of Health? What does this mean for vaccines? The FDA policy look like? So a lot of that uncertainty has weighed on the stock, and I believe it's priced into the stock. The reason why I like Merck is they're a leader in oncology, cancer therapies, and they've got about 20 different treatments that are in phase 3, not phase 2, phase 3. So that positions them well. And unfortunately, the trend of cancer is a trend that doesn't look like it's going to end anytime soon. So Merck's in a leadership position. They're also very good with M&A, and they can acquire companies on the cheap and do well with that. They're very disciplined about how they approach that. So citizens. Okay, so you go take a look at this. Jackson Financial this is a name we've owned for a while. We've talked about previously, if you've been following us. This is a spin out of Prudential. Okay. And the forward PE is 4.4. By the way, the funny thing about this stock, the forward PE used to be like 2 times. What kind of insanity is that? But here's what I like about it. It's not enough to be cheap because there are reasons stocks are cheap. And usually they're good reasons, like Walgreens, right? Of course, having said that, Walgreens probably rips next year, right? But so take a look at Jackson. What we like about it is, once again, buybacks, 6.27%. And they take the free cash flow divided by the market cap, you get a 90% yield. That's compelling. That's compelling. That means those buybacks are sustainable and they can increase the buybacks if they want. So this whole category of selling annuities to boomers, I like, because boomers are retiring. And when they retire, their risk aversion increases. They don't want to take market risk. So they want annuities. And there are a number of players doing well in this category. I could tell you 3 of their competitors. In fact, I've owned their competitors. So in this case, I think you could diversify across that basket. It's not about that Jackson itself is special, though I happen to Jackson for a few reasons above the others, but I think the others are fine too. The category is doing well. So sometimes you have a theme that's doing well. This is a good example. You just don't want to own the theme. Corebridge is another example of that. Lincoln Financial is another example of that. I think Jackson has the edge, but I think the other are fine businesses too. Okay, so Bumble is an online dating app. They're the number 2 player after Match. And Bumble, here's what we like about it. One is the forward PE is 5.6 times. This is dirt cheap. It was even cheaper before, by the way. Check that out. We've owned this now for a few months, by the way. We're up 20% on it. And what I like about Bumble is they're taking all their free cash flow and they're buying back their stock. Their buyback yield is 37%. I think the buyback yield that's sustainable for Bumble is closer to 20, 25%. That's fine. I'll take that though. If the denominator is shrinking, the share count is shrinking, and so long as the earnings are intact and the revenue growth is there, doesn't need a lot of revenue growth. You see some revenue growth. Can they cover the cost of inflation? Then this kind of idea, I expect, will do well. I don't see new entrants into the online dating space. It's a hated category. If you take a look at the analyst consensus estimates for the years ahead, they expect revenue growth that is really mediocre, right? 1.7% next year, then a drop the year after, then 4%. It's mediocre expectation. That's why the stock is cheap, by the way. That's also a sign that a lot of bad news is priced in. And it's gone up, 30% in the last 3 months. So this has a low bar to cross. It can surprise on the upside. But the free cash flow buybacks and low multiple is one of my favorite combinations to look for in concert with checking against these criteria. I don't want to do that, the value trap. So I don't think Bumble's going to go away. Match is interesting too, but their buyback rate is lower. They're changing their management team every year or so. It's an interesting idea as well, actually. But Bumble, I get a higher buyback rate. I like that idea. Maybe you own both, or maybe 2/3 weight to Bumble, but I think they're both interesting ideas. So this is called Biota. It's a hormone optimization and therapeutic wellness focused small cap. So these guys make money. That's good. All right. If you want to make money investing, then invest in businesses that make money. Wild idea, right? Turns out that actually works. So they have a number of locations around the US, and they teach clinicians and physicians on how to provide hormone therapies, which is a growing field, it's like an emerging trend. So they're generating free cash flow, they're generating earnings. The forward PE is attractive. So there's room for multiple expansion. We like that, right? If I can find multiple expansion and earnings growth together, that's good. The entry, by the way, is pretty good. So the forward PE, 7.3 times. The trailing PE is 28. This is a 213 market cap stock, by the way. So this is a young company. So higher volatility will be in this name.